First is income, then credit, and then the equity in your home, or equity also means how much do you have for your down payment? So think about it. If you have good income and you got sufficient credit to show on-time payment history, and you have, down payment funds or enough equity in your home to be able to get a refinance done, then you should qualify. I mean, there's a lot more to it, but let's start with those three categories. Hey, everybody. Welcome back to episode number 8 of the FACTS of L.I.F.E Podcast, hosted by me, John Doan. So if you've been watching this podcast or listening on in, you probably already know that on every episode, the acronym L.I.F.E stands for something different on every single episode. Today, we're going to be talking about loans and income and working with friends and family and empowerment. Okay, so let's begin. A lot of people always ask me, how do I get approved for a loan? As you know, I'm a lender and a real estate broker. And I get a ton of phone calls on a daily basis asking, how do I get qualified to buy a home? I'm a renter, I want to buy, or hey, here's my situation and I want to refinance to get cash out or to lower my payment. And I have a very, very simple way to explain how mortgage loans work. In our industry, I like to call it ICE, I.C.E. What we look at are 3 main factors to get you qualified. First is income, then credit, and then the equity in your home, or equity also means how much do you have for your down payment? So think about it. If you have good income and you got sufficient credit to show on-time payment history, and you have, down payment funds or enough equity in your home to be able to get a refinance done, then you should qualify. I mean, there's a lot more to it, but let's start with those 3 categories. Income. We want to see what you make on a monthly basis. Where's your income coming from? Is it stable? Have you been at your job for 2 years or longer? If you do have variable income, meaning commissions or bonuses or, overtime, have you been getting that for at least 2 years or longer, or is it temporary? We can't give you a loan based off of temporary income. We want to see that it's been stabilized and that this is the norm for you for at least 2 years or longer if you want us to use it. And that is for most wage earners. Now, if you're self-employed, whole different story. It gets a little complicated when we get into self-employed people because you file your taxes. If you have a company, your company files taxes, and then it breaks down to you personally on your personal 1040 tax returns. And depending on what you're able to deduct, standard deductions or write off on an annual basis, that's what your net income is going to be that we use in lending. And the unfortunate part is, what if you're allowed to write off all the things that you can, but by the time you get down to the bottom of it, it looks like you don't make any money? That isn't the truth. That is true as far as IRS tax code goes, so that you don't have to pay as many taxes because you're just following the rules. You're following everything that the IRS allows you to do out there, whether that's investing into your IRA or loading up your 401k or HSA for medical, right? Or so many other things that you could do, but having kids and the deductions from a state level, it's all very different, but it all comes down to what are you writing off and how much do you pay to the IRS if you're self-employed? Again, unfortunate, but that's the way it works. The more you pay to the IRS, the higher your taxes look for you to get qualified on a loan. And the less you pay the IRS because you have allowable deductions, your income will look lower. Okay, so that's basically how income works. And then there's all different kinds of other stuff. If you're getting Social Security or disability or alimony or child support or a pension, there's so many other things that fall in line with that income number that, can be used. However, when applying for a loan, just keep in mind, it's about a 2-year stability of whatever it is that you're receiving. And you got to be able to prove it if you want a standard or a traditional loan. How about credit? Usually getting traditional financing, if you're going through a GSE program, which is a government-sponsored enterprise such as Fannie Mae or Freddie Mac, FHA, or VA, any of those 4 buckets, they all have the rules and guidelines of what they'll go down to. But realistically, what does it mean? It means that if your income's high, but your credit's low, then you better make it up with the third wheel here, which is the equity or down payment part. It's got to be at least 2 out of 3 of these I.C.E items if you want to get qualified. So with that said, if your income is very high, but your credit may be, I don't know, 600, 620, you could qualify, but you need a bigger down payment, such as 20%, 25%. Sometimes you can slide with a lot less if it's a government program such as FHA or VA. They have lower thresholds on what you need. But I mean, that's also why these two programs have very high default rates. They don't require very much equity and they don't require a lot of credit. So if you're looking to do like a conventional type loan, a Fannie Mae or Freddie Mac conventional type loan, usually it's a 620 minimum. However, if you're looking online and you're seeing that rates are dropping and everything looks so good, I'm telling you, the minimum that you probably need to see these advertised prices, usually it's around a 740 and above credit score. That's excellent. 740 and above means excellent. And everything in the lending world, it works in 20 score increments. So like, let's say that the lowest that you need to get a loan through a government loan is set 580. Well, 580 to 599 credit score, you get one threshold. And then it goes 600 to 619, 620 to 639, 640 to 659, 660 to 679, so on and so forth, all the way up to 780. What we look at is the median score, meaning we don't take all three of your numbers from Equifax, Experian, and TransUnion and average it out. No, we do not. We don't pick the highest. We don't pick the lowest. We pick the number that's right in the middle. That's as fair as it gets as a display, because what if, I don't know, one creditor was reporting to one bureau, but not the other? Well, that's not fair. Mostly if it was a negative attribute of some sort. So if you have a 620 credit score and then, another one that's 705 and one that's 790, let's say, well, we don't pick the 790 and we don't pick the 605. We pick the one that's right in the middle, which is around that 720, and that's what you get qualified on. Now, if there's two people on the loan, we pick the lower of the two. So if you're married and either you're going on loan with your husband or your wife and your score is lower than your spouse's, that's who we're going to use, right? So the way to get around that sometimes is if you don't need the income of your spouse with a lower credit score, just leave them off the loan. They'll go on title with you, as far as the property goes, but they don't need to be on the loan. Therefore, you get better pricing and better terms just overall. With that said, it's like, how do you choose the best loan that's for you? This is very important. I think that's why we do very, very well. When you're calling around and you're interviewing and you're looking at different types of loans that are out there available, I think a lot of companies try to, push or select or promote certain types of loan products because the lender thinks it's easier. That's not always the case, right? I think that realistically, what loan is best for you, I think you need to, have your lender that you're working with review all, of the attributes that I just talked about: income, credit, and equity. And based on that, they should be able to come back to you with options that you can look at so that you can decide what you want and what's best for you and your family. All right, next, we're going to be talking about the I in life. And today we're going to be talking about income. Kind of goes with the first part of our episode, which was on the loan part, but income. What is the difference between verifiable and non-verifiable income? I want to touch on this as a segment into our next topic here because, a lot of people have verifiable income and a lot of people don't. What is the difference between the two? Verifiable means you work for an employer, you get a paycheck stub, everything is documented at everything that you make, every dime, every penny. You get a W-2 at the end of the year and you go and file your taxes, right? Well, how about everybody else that is not in that position? What if you're self-employed? What if you're 1099? What if you are a content creator on YouTube or OnlyFans and you don't get paycheck stubs? You're self-employed. Content creators are self-employed. You won't get a paycheck stub or some type of ledger. Instead, you get bank statements that show all these tons of deposits that you're getting from the revenue that you generate. Now, some of these folks who go and file for taxes, at the end of the year may have a lot of reasons to deduct or, to write off. So even though they make, let's say, I don't know, for example, if you get $20,000 a month in deposits, right? But your business, it takes you $10,000, $12,000 to generate that business, right? whether that's paying for the internet or camera crew or editors or, whatever it may be. If you're like an online influencer or content creator, there's a lot of work and expenses that go into it. So when you take the gross deposits that you make at the end of the year versus everything that you've had to spend, your income will, net out to what it is. However, on top of that, then you get more deductions. Maybe in this scenario, even though you got $240,000 in annual deposits or revenue, doesn't mean that, when you go to file taxes, it's going to say that. However, with the types of loans that we offer, we understand this and we know it. That's why we offer a lot of loan products where, we understand that you can't verify your income. Let's talk about a loan that I did not too long ago. I had a very high-end hotel, very high-end, talking about, I don't know, 1,200, 1,500 bucks a night starting in Los Angeles. And, it's fancy. Doorman calls me up and goes, yeah, everything I get is in cash, but I'm dealing with movie stars and superstars and athletes and things like that who are slapping him like $500 cash for tips, not once in a while, like all the time. If we went back and collected and how much this guy had saved up for his down payment to buy a home, none of this is verifiable. No one gives him a paycheck stub or says, hey, yes, I've verified that he makes this much, but he claims all his income the legitimate way that he should. However, with the way that he makes his money, it just doesn't look good on his tax return. So with us, what do? Right? We go and, look at his bank statements that he deposits all his cash into. And this man was making about $14,000 a month on average in cash, just from tips, if you believe it or not. People throw him like $500 or $1,000, and it's not that uncommon. He's been doing this 20 years. So as you can see, somebody like that who has unverifiable income, we can help. But that is the difference between verified income and non-verifiable. I really wanted to touch on this today because I talk about this a lot. I've had to, go and do talking seminars or trainings about this exact topic. So what a better way to discuss this than on our podcast today. Next, we're going to talk about the F in life. Today, I want to talk about family and friends, in particular, working with family and friends. I see a lot of transactions where, in real estate, where people own homes together, whether it's your spouse and yourself, whether it's with a sibling, whether it's inheritance that gets passed down to a group of siblings or other heirs. Or how about when I do business purpose loans or loans for the self-employed and you're dealing with partners that are family and friends? How do you deal with that? People ask me that all the time. Here at Equinox Home Financing, as a lender, I mean, our foundation that we have built is really family and friends, but there's pros and cons to that, right? However, I think it's really important to set boundaries upfront, guidelines, boundaries. How will it work? If this should happen, how do we deal with it? And I think that having that set up upfront so that there's a clear understanding is the most important thing that you could do. Um, I have several family members that work for me, and I work with my wife as well. I have several friends that work with me, or employees that over time, over 5, 7, 10 years, we become friends. And so there's got to be some clarity on how you deal with that. In my opinion, I would say that what's most important, again, is being clear and setting boundaries for, how to deal with things. First and foremost, I think that everybody's got to have the understanding that this is a business, right? And that it's work first, relationship second. And if everybody buys into that, then things will work. There's a lot of pros and cons. If you have family or friends that work for you, real close ones, right? People that you're very, very connected with, close with, not just, people that you wave hi and bye to, whether friends or family, but these are close people that are in your lives. I think that the pros is everybody cares. Like they give a shit, right? They really do care. And so, if you're down, they feel it. If you're up, they feel it. Opposed to people who aren't friends and family where, they're more concerned about their paycheck, their pocketbooks, what's going to happen to them. right? Where on the other side, we get people who are family and friends that are really in it. Not saying that for everybody, but that's usually the case, right? Most of the time. Otherwise, if they had a different personality or character, you probably wouldn't be working with them anyways, unless you really needed help. However, if this is the case, um, you know, those are the pros. The cons are, what if they underperform? What if they don't perform? What if you need to have a tough talk with them? Well, all roads lead back to the very first statement that I made. You got to have boundaries and clarity on the fact that this is a business and that it's business first and then friends and family afterwards. That's very important. So if you own a business or if you're on the other side, you have a family member or a friend that you want to work for, make sure these guides are in place. You cannot expect that the family dynamic will be the same in the workplace because of the very first rule of thumb. It's business first. You should be able to have two family members or two friends where one is, has a higher position and one who's an employee to be able to collaborate, talk, whether it's, positive, negative, or collaborative. Both parties should really understand that this is just work. And then when we, you know, walk out the doors and we go home, hey, it's back to where we have always been. All right. And the next and last part of our episode here is the E in life. Today, I want to talk about empowerment, right? As a business owner with not a large, but a good sized team with all different kinds of personalities and a lot of different types of personalities and a lot of different experience levels, a lot of different types of backgrounds. It's really important that understanding the difference between empowerment and control. I do not control people. That's not my thing. I don't micromanage. I don't have time for it. I don't like it. I don't like micromanaging. It bothers me. I feel like, hey, if I have to micromanage somebody and, give them work and check up on them and make sure it's done. And if they don't, I have to like go through this I don't do that. I want people who want to produce, right? So only can you give up control and empower to start with is it's with you. You have to let go of that control. And if you're going to give up that control and now you empower your people, instead of telling people what to do, ask them what they would do, right? Instead of like solving problems, ask for solutions. These are just some of the few things that you could do in order to empower people so that they could be proud and grow and learn, right? But if you're controlling, what I found is a lot of people who control, like people never move up. They never get better. They never experience more. They never learn. They've got to make mistakes, learn from them, go dig, research, ask questions, go figure it out. Only if you allow that part of your team or business to get to that point will you now be empowering people versus controlling them. And if you're really into micromanaging or controlling, I mean, I can't say for everybody, but I haven't seen a ton of businesses grow. I'm a family man. I have a family. I've got 4 kids. My whole deal of how I run my business is exactly this way. And a lot of people who know me understand this. Number one, I don't mess with people's money, right? Like that's the worst type of reputation that you can have. So, it's like pay first and then we could talk about the disputes afterwards and work things out, right? I mean, that's first and foremost. But realistically, as far as how I empower is I make sure that everybody on my team, it's like having dinner at my dinner table every night with my family. I know that if all my kids sitting around the table eat first and are fed and are full, everybody's going to be happy. And then I'll eat last. I'll get some too, right? But if everybody's happy and then I eat, I will be happy. So how do I convert that into my workspace is if I take care of all my teammates, everybody that's on my team and they're happy. I can't ever make everybody 100% happy, but if they're full and they are fed and they are making money, trust me, the money will roll in. And that's how I like to say that I empower my team to give them that opportunity to grow without trying to control them or micromanage them or look at every single thing that they're doing. Now, there are cons to that. If you're not good at catching these things up front, then you might go a long while of, I don't know, people who are taking advantage of you. But in that circumstance, you should be checking yourself and just having checks and balances in place to make sure that does not happen. However, if you ask me if I would ever change that or, pick empowerment over control, 100%, I'm all about empowerment. All right, everybody, that comes to the end here of episode number 8 of the Facts of Life podcast with me, John Doan. Subscribe, like, comment if you liked what you heard. Otherwise, we'll see you on the next episode.